Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Joel Fine. He's a full-time real estate investor and land developer based in Austin, Texas, a general partner in 1,200 doors and a limited partner in over 15,000 doors. Joel is also the principal in a ground-up development project spanning 157 acres in the greater Austin area. So thanks so much for coming on today, Joel.
My pleasure. Thanks for having me. Looking forward to this.
So tell us a little bit about your background, both personally and professionally, prior to being involved in real estate investing.
Absolutely, yeah. So if we go way back in the time machine, I studied engineering in college and worked for high-tech companies for several years after college as an engineer. Moved into management and then program management, also in engineering at high-tech companies. Worked and lived in Silicon Valley for many years. And really just focused on my career and my family. Real estate for me was only, hey, I need a house to live in, so that's real estate. Didn't really look to it as an investment, especially since I was living in Silicon Valley. Most of California really doesn't cash flow. The numbers just don't really work for cash flowing investments. So put my money mostly into the stock market and just heads down on a career. So that's my background before real estate.
So why did you choose real estate as an investment vehicle? You're being out in Silicon Valley. There's a lot of other assets to invest into. What attracted you to that asset class?
Yeah, so kind of a funny story. My wife and I decided maybe 5 or 6 years ago that it was time to move out of California. And we chose Austin as our destination. Couldn't move just yet. We still had one of our kids in high school. And just for one reason or another, we knew we wouldn't be able to move for a little while. So we decided to invest in a rental property in Austin, kind of as a hedge in case something crazy happened with either the real estate market where we lived or in the real estate market in Austin that would make it difficult to make that move. So we invested in a single family house, deployed it as a rental property, put a long-term tenant in it. That house for me was kind of the gateway drug to real estate. As I was studying real estate as an investment, one of the big revelations for me was that a lot of real estate markets are really different from California in fundamental ways. Mm-hmm. So I mentioned earlier, there's no cash flow in California, or really hard to find cash flow. But that's just not true in other markets. And I just never kind of explored real estate enough to discover that until I decided to buy that house in Austin. Found out that, hey, you could buy a property for, let's say $300,000 to get you a pretty nice house in the Austin area. And you can rent it out for a substantial fraction of that, and cash flow while you wait for the property to appreciate. And so I started studying not just the Austin market, but other markets across the U.S. Decided to make a few more investments in a high cash flow market in Ohio. Bought some duplexes, triplexes, and quads. Built up a portfolio about, I think, 35 or 40 doors at that point. At the same time, I was attending real estate webinars and meetups and meeting lots of people in business. Learned about the syndication model, where people gather groups of investors together to buy larger commercial assets. Got into that in a passive way. Invested in several deals as a limited partner, deals that other people that I knew were general partners on. And over time decided that was a really interesting and positive model for expanding my scope for scaling up into larger assets. So gradually shifted my focus from the smaller stuff that I was buying, the 2, 3, and 4 units, up to the larger apartment complexes, went into multifamily. So that transition happened maybe a couple, 3 years ago, where I started looking at doing deals as a general partner. Found other folks who had more experience than me and signed on with them first as a key principal. I can explain what that means if your viewers might not know that.
Sure.
But then went on and became a general partner in several deals.
Great. Yeah. Well, can you explain what a key principal is?
Yeah, sure. So a key principal is basically, but with commercial financing, the lender is going to want to have people signing on the loan whose net worth adds up to an amount that's greater than the loan amount. So if you're buying a property, let's say for $10 million, getting a loan for $7 million, just round numbers, the lender wants to see the signers on the loan have a net worth combined of $7 million or more. A lot of general partners don't have substantial net worths, or at least not yet. And so they look for other folks to sign the loan, but otherwise not be involved in the deal, not be decision makers or active asset managers who have substantial net worth, or who believe that the investment is a worthy one and are willing to put their net worth on the line to invest in it. And in exchange, typically the signer, the key principal, will get a piece of the deal, and that will vary substantially from one deal to the next. But that's a way that both parties can bring value to each other. As a key principal, I'm bringing value by signing on the loan and helping the transaction to close, and my partners are bringing value by giving me a piece of the deal.
Yeah. And that key principal, if the deal doesn't go as planned, that lender might step in and have that key principal take out some of the general partners and kind of put you in charge of running it, since you're the person that had the money that signed. So it's a great cash flow option. It's a great way of building wealth without doing all the work. But there's also, they have to really vet who they're working with as well. So.
Yeah, absolutely. And the key principal is taking on some risk, because signing on a loan isn't a trivial thing. If things do go sideways, the key principal is potentially at risk for the loan. So, as a key principal, I wanted to do my due diligence on the general partners, on the deals, on the markets, and so forth. So, it's something I went into with a lot of thought, but it was a way for me to connect with general partners and become more involved in deals than just as a limited partner, as a passive investor.
So Joel, I see on your website, you guys have acquisitions. You're doing a huge development project in greater Austin area. What is your current investment criteria and strategy where we are right now in the market?
Yeah, so I've shifted my focus over time. Initially, I was doing all value add multifamily, and I've connected up with some folks who do development and found that to be a really interesting diversification play. And also just it's development it's got different challenges and it's kind of fun, actually. So yeah, I'm involved in several different development projects. Most of them are in the Austin area. There's one up north, closer to Waco, which is about an hour and a half north of Austin. But and it's a variety. We're working on one large multifamily asset that's going to be over 300 doors, ground up development, where we've got a 37-acre residential subdivision that we're just going to carve up into lots, put in roads and utilities, and then sell those lots off to builders, let the builders take it from there. Nice. We're working on a 20-acre townhome development project in a town called Lockhart, which is about half an hour south of Austin. And then most recently, the one in Waco is a large master plan community. We're working out the land plan now to figure out what's the highest and best use of the land. So doing a mix of value add multifamily and development deals now. And in fact, more recently, it probably isn't on the bio that I sent you because it's very recent. I've started doing my first Airbnb. So that house that I bought 5 years ago in the Austin area as that initial investment had a long-term tenant in it for about 4 years. That tenant left, and we decided to switch it to a short-term rental Airbnb model. So we just did a major remodel on it, furnished it, and now have it listed on Airbnb. So just another way for me to diversify and get another income stream going.
Interesting. So tell us about some of the different challenges that you're now getting from being in construction versus when you were in value add.
Yeah, so construction is very different in a lot of ways. We're raising money from limited partners on the construction side too, but I make sure to tell my investors that it's a risky proposition. There's a lot of variability to the outcome, and we're making a lot of predictions about the future in terms of not just the cost of doing the development and how that development will go, but what the demand will look like when we're done. These developments are multi-year projects, 2 to 3 years from the time we acquire the land to the time we expect to have tenants in buildings. And over that time, a lot can happen. As we saw in 2022, that was a pretty eventful year on a real estate perspective, with interest rates spiking in an unprecedented fashion. So there's a lot of risks that can go with development. But it's a really interesting process because you get to explore some degrees of freedom that you don't with value add multifamily. Value add multifamily, you know the product you've got. You may be improving it in some way, but really the improvements are limited to mostly cosmetic stuff. Maybe you're fixing a roof or doing a parking lot, but mostly you're making the place look nicer. But if you've got, let's say, 52 bedrooms and 51 bedrooms, you're really not going to change that. That's what you've got at the beginning. That's what you're going to have at the end. And so your range of motion, the kinds of outcomes you can have are very, very limited. Whereas with development, we're looking at a bare piece of land. One of the projects we're working on, we thought about doing a retail strip center on a piece of that land, explored that from a market perspective, decided that the road frontage really wasn't suitable for retail. And so we switched to multifamily. So the use of the land changed in a very fundamental way early in the project. And so the range of outcomes can really vary widely. And likewise, the range of possible returns on investment can range very widely. Things don't go well, investors can lose their money. And I make sure that it's clear to people up front as they're investing that that's a potential outcome. Obviously, we try our best to avoid that. We underwrite very carefully to anticipate possible problems and hitches in the process, so that we don't lose our investors' money. We like to make them money, but we like to make it clear that these are not risk-free investments.
So with the impact, you mentioned inflation or rising interest rates, but the impact, what is the impact really of the inflation and rising interest rates where we are now? And how does your firm really, I guess, mitigate risk when doing development deals? Because as you mentioned, 3-4 years plus from the time that something's, you see the land to the time that it might actually have tenants in there paying.
Absolutely. Yeah. So that's a great and relevant question, because that's exactly what happened in 2022. And so, we very carefully underwrite. We try to anticipate, I wouldn't call them worst case scenarios, because you just never know what the worst case is, but we try to anticipate a range of possible scenarios of interest rates and inflation and changes in market demand and market conditions, so that even if things don't go particularly well, even if a few things go very badly, we can still make a decent return on our investment. And if things do go well, if conditions are better than we expect, then we'll all make more money and be perfectly happy with that. So in particular with inflation and interest rates, there's kind of offsetting effects there, actually, because as inflation increases, the tendency is that rents will also increase. There's also a little bit of a tendency for potential homeowners, let's say first-time buyers who want to get into the real estate market, to be priced out. And so they end up having to rent instead of buy a home. And so you could potentially get increases in demand for rental properties as a result of increasing inflation. So that can somewhat offset the effects, let's say, of inflation's increase in development costs. Wood goes up, metal, electrical conduit, pipes, those all go up in price. And so the cost of development can also increase. And so those can offset one another. Again, we try to underwrite for what we consider to be a fairly conservative scenario, so that we can anticipate the possibility of things not going to plan.
Interesting. So you're a passive investor in 15,000 plus doors. And what key factors should passive investors consider when evaluating a ground up multifamily project? Maybe they've never invested in one. Maybe they're not, I talk to a lot of LPs, and it's really, they're waiting for, a quarter or 2 quarters till they get their first distribution on a value add deal. And that's really what they're waiting for. I have other ones that aren't as worried about that. So how are you presenting, and how should a passive investor really consider and evaluate a ground up deal if they've never done one before?
Yeah, that's a great question. So first off, you point out a very relevant fact when people are deciding between different classes of asset. With ground up development, you're not going to get cash flow. You're spending 2 to 3 to 4 years putting money into the project to buy the land, entitle the land, get permits, and then of course do the construction itself, which is can be hugely expensive. And so there's no money coming in. There's no tenants, there's no renters, there's no cash flow. And so we like to make sure that, and is another expectation we set very clearly with our investors, is, hey, if you're relying on cash flow, if you're relying on this investment for current income, then ground up development probably isn't for you. Mm-hmm. But if it's money that you can put away for a relatively long time, and you're okay with no cash flow, but the potential of a nice big equity pop at the end, then you can consider this. And we also tell people, make sure this isn't your only investment. Make sure you're diversified in other things, so that, like I said, this is not a risk-free investment. So if things don't go well, it's not your whole net worth that's at risk. It's a fraction of your net worth, and hopefully other investments can make up for it. But it can be a nice supplement to an otherwise healthy portfolio. So that's among the considerations I make sure that people are aware of, is that, hey, don't anticipate any cash flow. The other thing is, just as with value add multifamily, but maybe even more so, the timeline is uncertain. Mm-hmm. We project out what it'll take to do the acquisition, entitlement, and build, but things can happen along the way that not only affect the cost and the financial returns, but also the timeline. For example, on the multifamily project we're doing in Austin, we learned a few months ago, not that recently, but somewhat recently, that one of the agencies that's going to review an element of our plan, called the traffic impact analysis, is backed up and is going to take several months to provide feedback. And we need to go back and forth with this agency a couple of times, because it's likely that their feedback will require us to make some changes to our plan and go back for more feedback. So this traffic impact analysis, when we're adding multifamily, we're adding 300 families to an area that didn't have those families before. And so the folks who are responsible for maintaining roads and figuring out how many lanes each road should have and where the turn lane should be and traffic lights and so forth, they want to know this so that they can figure out what their plans need to be, and whether we need to partner with them to improve any roads. There's a lot that goes into these traffic impact analyses. And so when we do one, it's an essential element of getting permission to build what we want to build. And so the fact that these folks are backed up in this government agency has an impact on our shovel-ready date, and then our overall schedule when we think the asset will be ready to deploy. So that's one of the risks we're facing is, hey, you just don't know what the timeline is going to be. You can predict based on past experience, but there's uncertainty there, and we've got to anticipate that uncertainty.
Yeah. I had a developer friend of mine that would say that development in real estate is like the venture capital of real estate. So, higher returns, but there's more risk. So as you said, it's a great way of supplementing your portfolio.
Mm-hmm.
So you're doing multiple deals. You're doing a huge 160 acre deal in Austin, Texas now, development. You're partnering with co-sponsors, I imagine, to do these deals. I mean, how do you build trust with your partners to handle different parts of different deals that your group is working on?
Yeah, that's a great question. So my partners and I'm partnered up with different sets of people depending on which project you're talking about. And so the partners that I'm working with, I've gotten to know over the years since I moved to Austin a few years ago. And first we might connect, let's say at a meetup or over coffee or something, and just sort of chat and get to know each other. We share past experiences, our track records. Maybe we'll work together on something where there's relatively little risk. There's a couple of deals I did early on where I was a relatively minor partner in the deal. For the first deal I did as a GP, I really wasn't doing a whole lot for the deal. I raised a little bit of capital. I sat in on meetings with property managers, but I wasn't a major decision maker. I was really just a bit player, and so that was a way for me to connect with that general partner, that investor, and work together on a relatively limited basis, almost like I don't know if you'd call it an internship, but I was kind of interning under him, learning the ropes, learning about asset management and so forth, and so that helped me get to know him, helped him get to know me. In that process, I connected with other general partners who were also involved in that deal, and it sort of branched out from there. So over time, we just, people get to know each other. They become aware of one another in the community. It's a relatively small community of people, especially in the Austin area, folks who are working on significant sized multifamily deals, whether on the value add side or the development side. So people just get to know each other and get to know their track records, and that's how you develop trust.
What are common mistakes you'd see real estate investors make, Joel?
Well, so I think the two fundamental mistakes that I made, I don't know if I'd call them mistakes as opposed to limiting beliefs, but the things I had to overcome to get into real estate investing and really understand it was, one was not all markets are the same. So as I said earlier, I lived in California and just sort of leapt to this invalid assumption that all markets are like California. So, I wanted cash flow, so didn't think real estate was interesting to me. And so when I discovered that different real estate markets acted differently, had different numbers, that was a revelation and helped me to really break through that barrier. The other limiting belief I had was that whatever I do, I have to do on my own. So if I'm going to buy a property, I've got to come up with a down payment. I've got to be able to make the loan payment. I've got to be able to manage it. I just had this image of myself doing these deals by myself, and that also is just fundamentally invalid, especially with the syndication model. I'm partnered up with 20, 30, 50 people on a deal, some of whom are general partners making the decisions, not all of them. You can't have 50 people in a committee making decisions, but you can have 4 or 5 with the rest passive investors. And that was also a revelation to me, a great learning to discover and understand the syndication model. Lots of folks have tons of experience in syndication, and it's sort of old hat to them. But when I was first getting into it, it was really a discovery for me to say, hey, I can get into commercial real estate with relatively little of my own money in by doing this thing, by partnering up with people, by adding value to partnerships, maybe doing the work, finding the deals, and so forth. So those were the two limiting beliefs I had that once I overcame them, really helped me to move forward in my real estate investing career.
Great. So how has your relationship towards money changed over the years?
Oh, that's a good question. I've always had a perspective of deferred gratification. I like saving money and not spending it. I like seeing my bank balances increase over time. And I love the time value of money, knowing that if I put money into a decent investment and leave it alone for a while, it can potentially grow and become a bigger piece of money that I can then roll into another investment. And eventually, if I decide to, I can take it back out and spend it on something that entertains me or gives me pleasure. But in the meantime, I really like saving, and I like delaying gratification on the money that I'm saving. So that's just always been the case for me. I guess really what's changed over time for me is the kinds of assets I go into. Early on, I was investing almost entirely in stocks, mostly in index funds. I'd put money into let's say an S&P 500 index fund, and those do well. There's over long periods of time, stocks generally return about 10 or 11% minus inflation. But once I discovered real estate and discovered, how I can use that to my advantage to get both cash flow and appreciation, that really changed my perspective and changed how I wanted to allocate my savings and my assets.
Yeah, and the tax a little bit more tax efficient with real estate as well.
Mm-hmm. Good point. Yeah.
What do you think are the main factors that have contributed to your success over the years?
Well, let's see. I think being willing to partner up has really changed, my ability to scale up and do different and bigger deals. Again, one of my limiting beliefs was I got to do everything on my own. And so once I figured out that, hey, that's not the case, I can partner up with people in different ways. That really opened a lot of doors, opened a lot of potential investment opportunities to me. And so that's been, I think, the most fundamental way in which I've, changed my trajectory is by partnering up with people.
So how can our listeners learn more about you, your business, and the exciting development projects you have going on, Joel?
Oh, thanks for asking. So yeah, I've got a website, lakelineproperties.com. That's LAKELINE, lakelineproperties.com, where people can go and check out my portfolio, my experience, a little bit about what things I'm getting into. They can also email me directly, joel@lakelineproperties.com. Happy to chat with people. Always looking to partner up with more people on different deals. So that'd be the best way for people to reach me is either go to my website or drop me an email.
Well, thanks so much for coming on today, Joel. A great time, and looking forward to connecting with you here in the near future.
Fantastic. I appreciate you having me.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.